In today's video, I'm going to be showing you the correct zones to trade from. The key points that you're going to take away from today's video is number one, what is supply and demand and the logic behind it. Number two, how to draw the correct supply and demand zones. Number three, what happens at supply and demand. And number four, how to trade a setup at supply and demand. Just quickly before we get into today's video, we've got our brand new trading missing pieces video that's out now. That is based on fractal highs and fractal lows, which shows turning points within the markets. You're going to understand all our 10-year knowledge on fractal reversal points. And now Trading Missing Pieces has over 15 hours of structured step-by-step content. So if you want to get access to that, you can do at notjustatrade.com. So let's just start now by understanding what supply and demand is. Essentially, supply orders are just buy orders or sell orders in the market. It can be a ranging price action. It can also be a fractal high or a fractal low price action. And these are the only two price actions that we always look for when it comes to trading supply and demand. The reason that we look for these specific price deliveries or representations of these specific price deliveries is because these show bank orders coming into the market or being fulfilled within the market. And it's the banks that move the price higher and lower, so it's their orders that we always need to follow and identify in the markets. This is a representation of a sell order, this is a representation of a buy order, this is a representation of a sideways range. Now inside sideways ranges, this is where volume is being created before then they initiate price higher or lower on the charts. A bank buy order or a bank sell order has exactly the same logic in the markets. We just identify their buy or sell order, and then we can follow along their intention, which is normally the bigger move in the market, the more explosive moves, the ones that's going to make us the most profit as quick as possible. So this is how I identify supply and demand on the charts. If we just have a look at the charts now, and you guys can go back through and do this on your own as well. You don't necessarily have to go bar replay. You have to identify the sideways ranges and you have to identify the buy orders and sell orders in the market. And then we trade those in the future. So now when it comes to sideways price action, all we're doing is looking for price to be contained between a high point and a low point on the charts. And then this is considered our buy volume range. We have many representations of buy volume ranges, but essentially it's just when price slows down and moves sideways, and typically there's going to be a lot of low volume looking candles followed by an initial breakout to the upside or a breakout to the downside. When we can start to identify these sideways ranges on the charts where price is contained sideways before we break out, we can see that price starts to create a story within price. We can see here as well a sideways range represented as a doji candle followed by a breakout to the downside. Price then reacts and sees continuation to the downside here as well. Now any representation of a doji candle is going to be reacted out from in the future. These are supply and demand areas. A supply area is always going to be followed by an initiation in the opposite direction or a breakout in the opposite direction with a very aggressive candle. A demand area is exactly the same. We're looking for that low volume price action followed by that very aggressive move or breakout of a sideways range. One of the most important things with understanding supply and demand is understanding where supply and demand is happening on the charts. Because of course, the banks are buying and selling all of the time. We can see that sometimes there is a supply and demand area in the markets, and we can see that price just blows straight through this area. So there is a specific way that we can be safer trading these locations on the charts. And when we get into actually trading this part, which is the section 4 of this video, then we can go into specifically how we can start to understand how to trade this area so that we don't get involved in these trades that just blow right through our mitigations. But right now, one of the most important things is to just identify supply and demand areas on the charts here. And when they've been taken out, which means prices run above the supply or below the demand, these areas are no longer valid in the markets anymore. So this is our first layer of understanding. It's just identifying sideways price action areas followed by an aggressive move to the upside. The key when understanding supply and demand areas and how to draw supply and demand areas is we want to look for the lowest point of the candle or the range and the highest point of the candle or the range before the breakout. Now we're drawing that at the lowest point and we're drawing that at the highest point. When we can see prices contained between a previous low and a previous high, then we're just drawing from the low to the high. When we have a very large sideways price action area like this, again, we find the highest point and we find the lowest point on the charts. So that's how to draw our sideways price action very clearly and very easily on the charts. Again, we just find the highest point and the lowest point, and then we look for the breakout. Now this brings us into section 3. What happens at these supply and demand zones? It's very important to understand what happens here. And this is where we bring in our concept at NJT, which is called RIMC. So these supply and demand areas, essentially how we see supply and demand is prices in a sideways range. We then break out of the sideways range. When price comes back into that range in the future, we see a phase called a mitigation phase. And then we potentially see that continuation phase and target that low. That is a full price delivery cycle of supply, or a full price delivery of demand if we look at this in the opposite direction as well. We use the RIMC concept because then we're not just looking for supply and demand, but we can create a narrative for price, direction and target. And the market follows a narrative. The more in tune we are with this market narrative, the more in flow we can be and the easier trading becomes. So analyzing the charts using the RIMC concept, we can understand what price wants to do and position ourselves with our strategy to enter with precision. So if we take that same understanding of RIMC and we understand all of the concepts of RIMC, a range and an initiation, and a range is just a supply or a demand area in the markets. What's actually happening when price comes back into this sideways range? Because we can see on the charts that when price does come back into these sideways ranges that have initiated out, and we see that mitigation and continuation phase, we're seeing very strong reactions that go on and move for a lot of pips to the downside. We can again see here a sideways range, initiation, mitigation, and continuation to the downside. And we see this just continuing, sideways range, initiation, mitigation phase. We never saw continuation here, but we still mitigated and saw a reaction away. And of course, we've got sideways range here, initiation that creates the low, mitigation phase here, and here again. And then we see a continuation phase from this location. So what's actually happening when price comes back into these previous sideways ranges that we have marked on the charts, which are also our supply and demand areas? Now, we have to understand the logic of how price moves and how the banks move price, because once we can understand how they move price and the logic of how they enter their positions into the market, that can then help us to understand the story of what's going to happen next. So inside these sideways range areas, or these sideways price action areas, there's a lot of orders being created. These essentially become your high volume areas, and we know that these are high volume areas because if we put a fixed range volume tool over the price, we can see that the highest volume areas on the charts are not actually those breakout candles that look very aggressive with a lot of momentum. These are actually low volume candles. The most volume is actually being created inside these sideways price action areas on the charts, as we can see here, which means this is where the large volume orders are actually being created in the market. So if we can start to understand how to see the representation of these sideways ranges, and we can identify these sideways ranges on the charts, that means that we can always trade behind a narrative, which is the RIMC concept, and we can create repeatable trade ideas following exactly the same repeatable process. So that then brings us into part 4 of this video. How do we trade a setup at supply and demand? So we have all of our areas marked on the charts. Let's go down to the 1 minute time frame and see how we can get involved at these points of mitigation. Let's start with this first one here on the left. So this is our previous sideways range that we had marked on the higher time frame. And we can see that prices come back into this area. Now we could refine this area to a specific sideways range on the charts up here on the 1 minute chart as well. So we have our very specific area. Now, a lot of traders will look at this area and enter in different ways. Some of traders will look at this area and enter with a safe stop loss above the high, which again is a great entry point, and you're playing an RIMC concept, which means that you can target this low down here for a potential 1 to 6. Now, you don't always have to execute in the markets like this. This is a great way to execute if you're very clear on the range that you want to play. And that's one method that you can use to enter the charts. Now, if we don't trade in that way, what other ways could we trade? Well, let's just play this forward here. We can see that when we play this forward, we've actually started to create a bearish trend in the market. We've got a high, a low, a lower high and price has created this lower low. So here's another way that we can look to enter the charts here. We can wait for a 50% pullback and play a continuation, and all we want to do is just look for another supply zone that's been created. We can see here between this low point and the previous high of the candle, this is our supply zone on the charts. Now you can enter this here with a stop above this high, or you can look to enter within the wick here and get a more refined stop on this entry. But what we're doing here is we're not anticipating that this is going to be the reaction point. We're waiting for price to tell us that this is the reaction point, and then we're trading away from this location here, which is a lot safer way to trade supply and demand. All we're doing is using our time frames here, and you can use any time frames. You could have a 1 hour supply and demand area, or a 4 hour supply and demand area, or a daily supply and demand area, and you can enter this same process on the 15-minute chart. But time frames are just a representation of the same data. The market is fractal, which means that we're just zooming in and out to get a representation of the same data. So this is a possible entry point here for a continuation to the downside. And we can see price pulls back into our previous supply area and then breaks the structure low and sees continuation there to the downside. So the best possible entry points on the charts is always going to be the reaction. However, that is going to be the most risky way to enter the market, but it's going to have the biggest risk to reward. If you wait for price to show its intention, which means we see continuation structure away from a supply zone, you're not typically always going to get the best entry, but you're going to get the safest entry to play as a continuation to the downside. And because price has broken this low, this would be you moving to break even on this trade, and you're now in a risk-free position. So that's two different ways that you can use to trade supply and demand areas from points of mitigation. So let's go back to our examples on the higher time frame and let's look at another example. So the next area on the charts that we're going to look at is this top area up here. We can see that prices contain sideways here between the low and the high before we saw a breakout to the downside. We can see that prices come back up into this location once, and then we can also see that prices come back up into this location a second, a third, and a fourth time. It doesn't matter how many times a supply zone is tested. If it gets taken out and we run above a supply zone, then we no longer look for entries here because price has invalidated this sideways range. But the banks can continue to sell at this location because if we look over on the right hand side of the chart, this is price. If the banks say that this is a good price that they want to sell from, then they will just continue to sell from this location over and over again and profit from the moves that are being created from this supply zone. This also creates a lot of liquidity when price reacts at this area multiple times, so that when the intention changes to bullish and we start to react from demand zones in the market, as we see here, and we see range, initiation, mitigation, continuation, this can now actually become a liquidity target following that bullish intention in the market. So you see how the banks can create a narrative and build the price delivery for that future intention as well. But the next area that we're going to focus on is this reaction that we saw over here. The reason that we're going to look at this reaction here is because it happened during London session and Chucks got involved in this trade, and many of the NJT traders got involved in this continuation trade as well. So that's our narrative built. We've got a sideways range, we've got an initiation. We know that when price comes back into this mitigation phase, we can potentially see continuation, which is an aggressive move away. So now let's go on to the minute chart and look for the entry that we could have got involved in as a continuation. So we're now down here on the 1 minute chart. We're at our point of mitigation that we drew out earlier, the previous sideways range. And an important factor about what's happening here is that this is happening during London session. We can see on the time on the bottom, it's 8:30 a.m. and we've just run into our point of mitigation here. So now what we're waiting for is price to create a sideways range here and see an initiation to the downside. Remember that pattern that I showed you before, sideways range, initiation, mitigation, continuation, because this shows bearish order flow coming into the market. This also shows the banks continuing to sell from a previous mitigation, which means we can follow that narrative to the downside and play the continuation to the downside. So here we can see the sideways range being created in the market. This is our supply zone that's now being created. Remember I said I always look for a breakout with aggression and speed. So we play this forward and price has seen an aggressive move to the downside. So now we know that we have our very specific area that we can look to trade from with our stop above the high at a safe stop. Now there's a few different ways that you can look at trading this. Because we've already got our direction within the market at a point of mitigation, this is a lot safer way to trade. We've also got a bearish trend. We've got a high, a low, a lower high, and price is now creating a lower low, which again is our continuation structure away from a point of mitigation. So now it's just about your stop loss. Do you want to play this at 50% and you want to have a 3 to 4 pip stop loss and a massive risk to reward? Or are you just happy to get involved at the open of the range and have a larger stop loss? Whichever is up to you. I know Chuck's played this with around a 3 or 3.5 pip stop loss because he always targets a 1 to 10 risk to reward. Not only Chuck's, there was also members inside NJT that caught this exact same move. I'll put those on the screen as well so that you can see. But this is what we're doing. We're just looking for those supply zones. We're looking for price to show us its intention, and then we're playing those continuations from that higher time frame supply zone. This is how we're using RIMC together to understand the direction within the market. So let's just play this forward. We can see that price comes back up into our supply zone. We get the reaction here as well. So now what are we anticipating? Well, if our range, initiation, mitigation, continuation plays out, we know that price is going to target this liquidity low down here for that continuation. And when price ends up taking out this low that we have down here, that's when we can start to move to break even and see if that intention is going to play out there to the downside as well. Even if you miss that first trade there, we can see that price has also reacted from supply zones that have been created in the markets here as well. So there's plenty of other opportunities that you could have been involved in this move here to the downside. We broke the low here, so our rules then say move to break even, and you're now in a risk-free trade. And because we're playing the higher time frame intention, we can start to anticipate that higher time frame move playing out, which is always a bigger move in the markets. Let's just play this forward. And we'll go back to the 15-minute chart. And here we can see our supply zone again. We can see in the future that we're playing that supply zone playing out again to the downside. And all we're doing is trading with the continuation structure from a location that we anticipate a move to happen from. And if I just play this forward now, we can see that we had that very strong reaction to the downside. And this is where Chucks and also members of NJT were able to capture 10%, just understanding supply and demand zones, and then zooming into the 1-minute chart to play continuation structure away from these zones. Hope you guys enjoyed this style of video. Make sure you leave down in the comment section if you did enjoy this video, and we'll continue to make these. If you want to find out more about how we trade, make sure you click the links in the bottom of the video. This has been NJT Burton, and I'll catch you on the next video.